is how many more years do you think we've got of structural growth for the cloud before this starts to become a business line that is tied to whatever the economy's doing, to become a bit more cyclical?
Yeah, that's a great question, and thanks for having me back. I actually still think we're relatively in the early innings. I would call it maybe innings 3, 4, 5. In this year's State of the Cloud report, we talked about how much room is left where cloud software will begin to eat traditional software, on-prem software. And we've got at least 6 innings left. So we're predicting somewhere in the next 4 to 5 years where cloud software will become the overwhelming delivery method and product in the space. But we've still got time. We're still in the early innings.
Does the Snowflake price action, first of all, were you guys in that deal at all? And does that action make you question the IPO price process, as some of the major venture capital hitters, as Deirdre Bosa told us, are doing?
I don't spend nearly as much time thinking about, direct listing versus banker-supported IPOs. I know that everyone's out here trying to do the best job that they can. I've got a ton of friends at Goldman Sachs, Morgan Stanley, and I know they're doing the best to match great companies with great public opportunities of the investor base. So I don't necessarily think about it too much. What I really care about is that, folks like us on the venture side have the opportunity to back really ambitious founders. So when I think about Snow, for example, Frank is just an incredible founder that's got an incredible product going after a massive and still growing market opportunity. And that's where I focus most of my time.
Obviously, when we look at this particular IPO and company, Elliott, on a P basis or price to sales basis, it looks incredibly expensive. What are the key metrics you look at for a company like this?
For sure. So here at Bessemer, we spend a lot of time with our emerging cloud index, as you guys know. And typically we use something called the rule of 40. So it's a kind of juxtaposition between your growth rate and your free cash flow margin. And typically, the companies today are somewhere around 35% growth year over year with a 5% cash flow margin. And those companies receive about 17 times current run rate and about 14 times forward. So if you juxtapose that against Snow, this is a behemoth top line, 500 million of run rate and above company growing 120% still with some losses. But because their rule of 40 score is much above, 50% plus, they're going to see, revenue multiples in the 30s, sometimes even closer to 35, 36 where they were yesterday.